FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. And in this video guys, we're going to take a look at risk management. And I'm going to go ahead and walk you through a simple plan that anybody can follow to get you started at least with having good risk management. At the end of the day guys, if you don't have good risk management, you're not going to last. All right. So without further ado guys, let's get this started. If you're new to the channel, please consider subscribing. Also, if you haven't joined us yet, please go to fxntrading.com, create a free account, and join us in our Telegram group where we have a large community of traders that are helping each other trade and becoming better traders. All right, guys. So with that said, let's go ahead and get started with this video today. All right, guys. So let's talk about risk management. So what is risk management, right? What is it? Essentially is basically talks about your balance, right? Is you knowing what you're risking versus your capital that you have. So knowing that, for example, if you have $5,000 in your account, in your trading account, how do you correctly risk that money in order for you to make more money, right? Because one of the biggest things that I feel is just wrong with the Forex industry is the fact that there are dealers and brokers out there that essentially give you ridiculous leverage. And obviously they do it for a reason, right? They know that, there's a crazy high percentage of turnover because of the high percentage of traders that will fail. Okay, and those are just the facts, right? They say 90% of traders fail within the first 90 days of starting to trade, and that's really because they don't have any kind of real good risk management plan. They don't know what they're doing, right? And so they have this notion. They come in with the mindset of, yeah, I'm going to trade some money and make some money real quick, and I'm going to get rich off of this, and everything's going to be all good. And the reality is that it's not like that at all. You need to know how to properly use risk management on every single trade, because if you don't know how to use it, your account's really just not going to last. It's really not. And over time, you're just going to get frustrated and you're going to quit. But you're going to quit after you blow your account. So let's go ahead and go over some real basic, quick, and simple risk management that I think everybody should use. And it's just very simple and it's very common sense. All right. So for this example, I'm just going to use, let's say, a account with $5K, so $5,000. All right. So a $5,000 account is what we're going to use for the example. All right. Now, out of this $5,000, okay, your total risk is going to be your total risk is going to be 3%. And that's 3% out of the 5,000, not 3% per trade. Okay. So the amount of capital that you use or that you have basically to trade should determine the lot size that you're actually using to trade with. All right. So again, your capital that you have in your account, the money that you have in your trading account, that is the determining factor as far as what lot size you should use. Okay. Not how much leverage you have or anything like that. All right, the leverage you have depends on the broker that you have, and it also depends on the country. So, for example, if you're in the U.S. and you're a U.S. citizen and you live in the U.S. and you have a legit broker that's actually regulated, right? That's not a broker from any of the islands here. So if you have like a U.S. broker, like let's say for example, Oanda or Forex.com or any of those U.S. brokers, your leverage is capped at 50 to 1. Okay. Now, if you go outside of that to other brokers that are not on the mainland on these islands, like I believe Hugo's Way, Trader's Way, any of those. Not to pick on them, by the way, it's just examples. They offer, crazy leverage, like 1,000 to 1 leverage, right? Or higher sometimes, depending on the broker. All right. So I want you to understand that the leverage part really doesn't matter. All right. And here's why. Because of the lot size that you pick is going to be depending on the balance that you have. So on a 5K account, what should your lot size be? What do you think your lot size should be? Well, I'm going to tell you that your lot size should be on a $5,000 account. It should be 0.50. That's what your lot size should be on an account with 5K. And that's 0.50 as your max. Okay, so that's one trade at 0.50. So that's $5 a pip, basically, right? And that's as a max. Now, what happens if, one day you come into the market and you literally just have the most horrible day ever and you make the worst trade possible of your life? Okay. The worst thing that could happen on that day is you lose $150. Okay. So that's the worst case scenario, is $150. All right. Now, if you're following, rules like from your trading plan or whatnot. So let's just take, for example, some of the rules that I talk about in other videos in my Trading with Market Makers playlist, for example. I talk about having a 15 pip stop loss, right? So let's say you take a trade at a 0.50 and you lose that trade and you're using that rule of 15 pips, right? Well, essentially what you did is you ended up losing $75 on that trade. Okay? So essentially that gives you one more opportunity to go in on another trade at a 0.50, right? Because 75 is not 150, right? So you have another $75 basically to spare. Okay. Now what happens, and this is solely off of making one trade at a time. Well, what if you want to take, 2 trades, right? Well, what you're going to have to do if you want to take multiple trades is basically just split this 0.50 into multiple. So let's say if you want to take 2 trades, you'd basically do 2 trades and each trade would be at 0.25. Okay. So 2 trades at 0.25. If you want to do 2 trades. If you want to do 3, divide it into 3. 4, divide it into 4. And so forth and so on. Okay. But let's say each of your trades maximum is going to be 15 pip stop loss. Okay. So worst case scenario, again, if all hell goes breaks loose and you just make horrible trades, the worst thing that can happen is you losing $150. Okay. So now think about that compared to, let's say, if you were doing, let's say if you still used 0.50 as your lot size, but you were risking 3% per trade. Let's say you did that 3% per trade, and let's say you put multiple of these out there. You know, and you're like, oh, it's okay, I'm doing 3%. Well, no, you're not. You're doing obviously 3% per trade. That's, you know, if you do 3 trades, that's 9% of your account, right? So 9% of your account. Now you're talking about losing $450 instead of $150, right? So you may be asking yourself, so how do I get a bigger lot size to trade, right? How does this number get bigger so we can make more money? Well, for this to get bigger, this has to get bigger. So once this gets to 6K, this 5 turns into a 6. 7K, this turns into a 7. So forth and so on. Once you get to 10K, now you're trading at a standard lot size. Okay. The 10K is hugely important because once you hit 10K, if you leave the money in your account, the compound effect starts to kick in really good at 10K. So you want to have some major growth in your account, get to 10K, and that compound effect will start to kick in. All right, so let me show you guys how this compound effect works when you start getting into 10K. All right, so let's say you got $10,000. All right, and we're going to make very moderate money. We're not going to do something crazy here, okay? We're just going to do, let's say, 5% a month. That's basically about $500, right? $500 a month on a 10K account, totally possible. Nothing too crazy or extravagant, right? So after 12 months, what are we looking at? $17,000, almost $18,000, okay, in your trading account. Now we bump that up to year number 2, and where are we at now? We're at $32,000. All right. We go to year 3, and where are we at now? $57,000 in year 3, right? Now here is where it gets really interesting, because look what happens when we get to year 4. At year 4, you're at a 6-figure income. Now think about that. 6-figure income on year 4. Just chipping away at 5% per month consistently and keeping your money in there. Where can you go in 4 years and make 6 figures? Not a lot of places give you this kind of opportunity, right? So the crazy thing is, you know, check out what happens, you know, the next year. Now we're at 186, almost 200,000. And essentially you get the picture, right? There's next year. So essentially 72 months. Look where you're at 5 years later. You know, you're close to $335,000. And again, this is being very moderate, right, with only just 5%. So just think about that, okay? I just want you guys to think about that. So the compound effect is hugely important, because if you're consistent, okay, if you're consistent, you can get there and you can have anything that you want to. The hardest part about trading is not putting in the trade. Putting in the trade is actually the simple part. It's just clicking a button. The hard part about trading is what happens after you put in that trade. The psychological effect that goes in once you put in a trade. You know? So if you guys want to do this for real and not BS around and treat it like a hobby, you have to treat it like a career, because that's what it is. This isn't a hobby that you can just do, and think that you're going to get some really good income. It takes time to learn. It takes a lot of work, just like with anything, just like with any profession. You want to be a doctor, you go to school for 10 years. You want to be a mechanic, master mechanic or something, you have to be an apprentice for years. You have to go to school for years. Everything takes time. So the real question is, do you have the time, to put into this so you can start reaching the goals that you want to reach financially? And the goals are obtainable, as I just showed you. They're obtainable, and it's not crazy, you know what I mean? We're not talking about making, $10,000 a month. We're literally talking about consistently 5% on 10K, 5% a month on your account. That's it. So it's possible. So the question is, can you just follow a simple plan, a simple risk management plan? Can you just follow it? And just be consistent with following it. That's it. That's all you have to do. It's just be very consistent with following the plan. I can tell you everything, that you need to know. I can give you a roadmap to success, but if you don't follow it consistently, then what good is a map? If you don't follow it. All right. So I hope that this risk management plan made sense to you guys. I try to make it as simple as possible for you. So again, I hope this brought you value. Guys, let me know in the comments if you like this simple approach to having a risk management plan for your account. And again, the balance of it itself determines what lot size you use. All right. So another quick example is, if you're starting out with a very small account, let's say $500, right? What should be your lot size? Your lot size should be 0.05. And that's your max. Right? Still same thing. 3%. And that's of your balance. Okay? You want this lot size to go up, then you have to make more money. 6 becomes 7. It makes sense. When you get to 1K, now you're trading 0.10 lot sizes. Okay? It's just that simple. It really is that simple. And you take essentially the leverage part out of your account, because the leverage is not going to matter. Even if you have a 50-to-1 leverage, it's really not going to affect you, because you're taking the correct risk management lot size per trade. So you'll be okay no matter what leverage you have, whether it's 50-to-1, 1,000-to-1, 3,000-to-1. But make sure that you're with a legit broker, a broker that's regulated. It's your hard-earned money. So just make sure that you're protecting yourself, just being with a broker that's regulated and that's trusted. All right, guys. So thank you so much for watching this video, guys. I really appreciate the time that you take to watch my videos, and enjoy the rest of the week of trading, guys.